Hello, everyone. It's Thursday, October 27th. I'm excited today to talk to Jesse Felder, some really cool long-term charts to help put this market into proper perspective. Weak tech, strong other things. Let's look at the charts together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts. The technical toolkit, I would argue, is optimized for this sort of environment. When things are confusing, when we have elevated volatility, elevated uncertainty, taking a step back from your screens, looking at the trends, focusing on what's working and what's not, and using charts to make that determination, I think, can serve you very, very well in this environment. I was writing a note for my premium members of market misbehavior earlier today. One of the things I was sharing with them is this sort of, I don't know if bifurcated is the way I would describe it, but sort of this, it's a tale of two markets, right? If you're looking at particular charts, the market probably feels really heavy right now. Alphabet is a perfect example of one of those names just getting crushed this week among a long stretch of being crushed. On the other hand, you have charts like GPC and LPLA and others making new all-time highs as the week progresses. So we'll look at some of those charts together, see what conclusions we can draw. Do want to let you know about the schedule coming up. Excited to talk to Jesse Felder here a little later in today's show. Just so you know, I am planning to head to Mumbai coming up on Saturday. I'll be in India all of next week, so we won't be doing a show all of next week through Tuesday, November 8th. After that, we'll be back live with you on Wednesday, November 9th with Frank Capilleri, on Thursday the 10th with Leslie Juflas locally here in Seattle, and then the week after, Larry Tentarelli. I will have a lot of really cool discussions in India and hope to share as much insights as I can upon my return. Let's continue on with our show today with our market recap. Let's break down the activities in these markets and use charts to tell the story. This is one of those interesting days that reminds me of a common occurrence we had through much of the first half of 2021. The Dow higher, the NASDAQ lower, and the S&P kind of caught in the middle, right? With some old economy and some new economy names all mixed together. The NASDAQ down 1.6%, and that's in no small part, if not primarily because of the weak earnings data coming out, right? Stocks like Meta and Microsoft and Alphabet and others, continuing to press their lows and continuing to struggle. So the Nasdaq, look at the Qs, the market's in a pretty, I won't say desperate, but certainly in a valid downtrend. You look at the S&P or the Dow and things are a little more nuanced, right? A little more constructive probably. And if you look at a lot of individual names that are in the S&P and the Dow, things are downright bullish, right? This is one of those interesting environments. It reminds me a lot of the first half of the year where the markets kind of net out to a flat to negative, although there are charts that are working and charts that are not. This is a really good time to, I would argue, to upgrade your scanning game, your alerts game, and focus on the charts and the names that are working. The VIX, by the way, still below 30. And we talked about how the VIX above 30 is sort of that measure of elevated volatility, at least what 2022 has looked like. We're going to do a segment a little later in today's show called Getting Sentimental, where we'll look at the VIX, some of the other sentiment readings. So I'll save further discussion for that point. Mid caps and small caps, by the way, both finished in the green, just barely. Interest rates coming off a little bit. And if you look at the 10-year yield for the last couple days, we were up about 4% 2 days ago. Sort of ended yesterday just above 4%, today pushing a little bit lower. So you've seen bond prices starting to improve a little bit. So it was interesting to see value kind of outperform growth on a day that rates are coming down. So that is sort of the traditional narrative has been the opposite of that for much of 2022, right? Higher rates, stronger value relative to growth. Today, you actually had rates come off a little bit. And value stocks actually doing just fine today, having a decent up day with the industrial sector up over 1%. The dollar pushing higher, which certainly is not going to help equity prices. Generally speaking, that's kind of been the narrative, and that's played out so far today. Gold and silver essentially flat for the day. Oil prices a little bit higher, and the energy sector did all right. We'll get to sectors here in a few moments. Cryptocurrencies, a lot of red on here, but not by much. And as I was looking at the markets yesterday and today, I'm noticing how Bitcoin firmly above 20,000, at least for now. We talked for many moons, we've talked about how Bitcoin, for me, it's all about a line in the sand, right? At what level do you agree to revisit a thesis? And my general take has been Bitcoin's a chart in distribution phase. But if and when Bitcoin gets above 20,000, then you have to rethink whether or not that downtrend is in play. Let's look at the chart of Bitcoin here next, and then we'll get back to looking at some of the other sector and individual stock themes that played out through the course of the day. Here's my chart of Bitcoin. This is sort of the general chart that I've used. And, these green trend lines tell you the story of much of 2022, and it really started in the end of last year, where you have Bitcoin making a big leg downwards. Then you have sort of this consolidation period. Those consolidation periods usually took anywhere from 1 to 3 months. Then you'd have a break to a new low, sort of a new pattern of distribution, then a consolidation phase, a new breakdown, a new consolidation. That all sort of played out until September when you had a breakdown, but it really didn't undercut the previous lows. From there, that low from June so far has held. And one of the things when you think about the likelihood of stocks appreciating, and I'm thinking of Bitcoin as just a general measure of speculation, right? Are speculative pressures alive and well? Are people speculating in some asset class that probably would indicate some sort of opportunity for equities? I think you're starting to see that, right? Bitcoin arguably certainly has stopped going down. At worst, it's in a consolidation phase. At best, it's maybe a bottoming phase. But how do you tell that a chart is exiting the bottoming phase or the basing pattern and starting to improve? Well, it has to start making new highs, right? And that's where I think that 20,000 level is pretty key. That's a big round number, right? And so a lot of people, when you change the first digit in anything, people naturally start to reflect on what that represents and whether something like Bitcoin deserves to be up with the up to a 20 handle at the top. And you can see that that's actually what happened over the last couple of days. We now pushed above 20,000, and now so far holding that. I think as long as Bitcoin holds 20,000, this could be the beginning of something a little bit further. Again, an uptrend is a pattern of higher highs and higher lows, which means if you see that start to play out, that's what we give more and more confidence to some sort of recovery. As always, I suggest people start where we're at and look to the left. Start at the final bar, which was one of the reasons why we named the show like this, and look to the left. What levels stick out as important? As you can see here, the peak in September, 22,500, the peak in August around 25,000, and that lines up pretty well with the 200-day moving average. If we do see further upside from there, those are some objectives I would certainly be looking at. And if we can eclipse those levels, then and only then, I would argue, can you start to look for further upside potential in a chart like Bitcoin. Briefly on the chart of the S&P 500, it's fascinating how the market trades around levels that in some ways feel incredibly predictable, right? When you see the market making a new low in mid-October, early October, and you see the rally start to come in, we have that great bullish engulfing pattern at the lows, not just on the S&P, not just on the NASDAQ, but a lot of individual stocks had a similar pattern right about there. We've pushed higher from there. The last couple of weeks have certainly been more positive, and I immediately started to key on some key levels. The 38.2% retracement level around 3,800, the 50-day moving average currently around 3,850. So I am not surprised that the market has rallied right up to around 3,800, a little bit further, right to the 50-day moving average. And now 2 days we've shown distribution, meaning we've opened, we've traded above that level, and now coming back down there. If you know your candle patterns, by the way, do you know what this candle pattern is from yesterday? What's funny is we did a poll question. I think I shared on Tuesday's show, and this was actually alluded to in the question. It wasn't this particular answer. So this you could probably label one of two things. I could see the argument for what's called a shooting star candle, which is sort of like an inverted hammer is what you'd call it at the bottom, where you have a low, limited lower shadow, a big upper shadow, and the open and close are right at the bottom. So that's sort of, we opened, we traded higher, but by the end, we're right below the lows. That's called a shooting star pattern. You can also call this, because the open and close are almost identical, it's called a gravestone doji, and it's about as bullish as the name of that would probably imply. It suggests short-term distribution. So Interesting to me, we hit the 50-day moving average. We have a distribution candle pattern. And from there, it tells you the next 1 to 3 bars most likely down a little bit. So as I'm seeing the tech earnings come out through the course of this week, I'm seeing some patterns of distribution in some of the biggest names. I'm not surprised that we get a bit of a pullback from those levels. Now, what's so interesting about that as we wrap up our market recap here just briefly is the fact that some stocks are just working. If you look at the industrial sector, the financial sector, energy, you see stocks making new 52-week highs are very close to doing that. So there are names that are working. Make sure you're looking for the charts demonstrating strength. We need to take a quick commercial break. We'll be back with today's guest, Jesse Felder. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. Thanks so much for being patient with us this week. I've been fighting a sinus infection, so I'm super excited to be back live with you today. I had to take the show off yesterday, but we are in full recovery mode. As certain stocks seem to be, I seem to be in a similar pattern of recovery here. A couple quick announcements before we bring on Jesse Felder, our today's guest. First off, we welcome your questions. We'll do a mailbag segment on tomorrow's show, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to stockchartstv.com. That is our on-demand platform. I'm so thankful we have great guests like Jesse Felder, Miss Schneider, Katie Stockton, Larry Williams, so many others coming through our shows and sharing their expertise during challenging market environments. So go to stockchartstv.com to capture all of their content, or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Jesse Felder. Jesse is the editor of the Felder Report, coming to us from Arizona. Jesse, great to see you. Welcome back to the show.
Yeah, thanks for having me back, Dave.
So I appreciate this market. It's been, I think it's very easy to get drawn into the short-termism, sort of the flickering ticks of the day-to-day movements. You are helping us take a step back and looking at the big picture. Talk us through this first chart, which is really looking at earnings in the equity space, right?
Absolutely. And I think this market in general has been really, kind of lent itself towards more tactical types of signals and things. But I think this bigger picture stuff also can help with just laying a foundation for what is the overall trend in fundamentals and in technicals. And there's a 2-year leading indicator that's really effective for the economy, for earnings, and all these things. And it's just essentially a composite of interest rates, oil prices, and the dollar. When these things are rising rapidly, it usually creates an earnings recession, an economic recession, about 2 years afterwards, and vice versa. When you see these things top out, roll over, that's usually a bullish, positive thing for the economy and for earnings about 2 years in the future. This is also a really good leading indicator for things like ISM, PMI, and a lot of just traditional economic indicators. So right now, because I think we're potentially witnessing an important top in the dollar and interest rates, but that wouldn't necessarily be bullish for, another at least 12 to 24 months for earnings. So because these things have been rising so rapidly over the last year, we're probably in the very early innings of an earnings recession that hasn't been quite priced into the market yet. So fundamentals are still pretty bullish, I think, over the next 12 months. I'm sorry, bearish.
It's so interesting. We tend to think of so many things as kind of coincident, right? And I think we're in the age of instant gratification on many levels, but this one's showing there's a bit of a delay, that relationship and how it evolves over time. It's really interesting. Your second chart is really looking at the big picture on the S&P 500, thinking of different cycles. What does this tell us?
Yeah, and I think the question on a lot of people's minds is, when is this bear market going to be over, right? I mean, it's been painful so far, but Edwin Coppock created this indicator. It was first published in Barron's 60 years ago, and he was tasked by the Episcopal Church to come up with an indicator that would help investors know when a good long-term buying opportunity presents itself. And so he created this kind of long-term trend following indicator, the Coppock curve, it's called. And the way he used it was when it bottomed out and started curling back up, that was a sign that probably the bottom was in for the market. But you could see we just crossed below the zero line in the last couple of months. When you look back at when that's happened the past two times, it's been a sign that you're probably in the early stages, or at best in the middle of the bear market, and there's still a fair ways to go. So, this is another one to keep your eye on, I think, for as a longer term investor or just as a trader trying to understand the longer term trend, that we're probably somewhere closer to the middle or the early first few innings of this bear market rather than closer to the end of it.
I did not realize the Coppock curve had gone below zero. Thanks for the heads up on that, Jesse. I don't know if I'm glad I've seen that or not, but probably. So given that as the environment, Jesse, when you think about if we may be sort of in the middle of this bear market phase, we're in this environment right now where if you look at energy, if you look at financials, as I mentioned in the market recap, you have certain areas of the market that are actually doing just fine, but the major index is obviously struggling to kind of feel their footing. As you look forward just between now and year end, what would you be looking at in terms of positioning? Is it a time to remain defensive and just sort of weather these storms, or is it more opportunistic and look for where the movements are really resonating?
Yeah, from where I sit, the tactical indicators don't necessarily agree with those longer term ones, as you pointed out effectively, that we saw some kind of waning momentum in these signs, and we have that bullish outside reversal in a lot of charts and things in the last few days, and the oversold condition lends itself to a potential for continued rally. There's seasonality and other things working in its favor, but I think how traders might want to view this rally is an opportunity that if the earnings are going to weaken, the economy is rolling over, ISM is going to roll over, that's typically an environment where you want to favor defensives over cyclicals. And so I think this is one of the reasons why the NASDAQ has been underperforming, is if you look at just the cyclicals, consumer discretionary, and QQQs, they trade almost exactly in line with each other. So it's like NASDAQ 100 is essentially like a consumer discretionary ETF. And that's something that when the economy is weakening and rolling over, it really kind of leads to the downside. So I think it probably makes sense to favor more traditional defensives like staples, healthcare, utilities, and look to sell rallies in more kind of cyclically sensitive types of things.
It's really helpful. I noticed, even in consumer staples, you're seeing a number of charts starting to work, food products and others, where you're starting to see some improvement. Jesse, listen, it's awesome as always to have you on the show. Thanks for some long-term charts to help us think about the different timeframes at work here. I think that's tough for a lot of investors to understand. Stay safe, be well there in Arizona. We'll talk to you again soon.
Thanks, Dave. Always enjoy it.
That's Jesse Felder. Jesse is the editor of the Felder Report. I love those charts. The Coppock curve, by the way, boy, we haven't talked about that. I don't know if I've ever brought that up on the show before. The financial industry is full of some really interesting, fascinating tools to help you understand sort of that bigger time frame, sort of that cyclical plus, I guess, that secular time frame. The Coppock curve is a common technique that I've talked to investors who have been doing this for 50 plus years and have always been fascinated by that long-term rotation. Interesting what that tells us about the bearish potential long-term, but the tactical strength that we're seeing in the short term. Make sure you think about the appropriate time frame and what time frame you're trying to operate on. Great take there from Jesse Felder, as always. Let's continue on our show today with our next segment, Getting Sentimental. A lot of the sentiment data that we review is updated on Wednesday and Thursday, so it's a really natural time to take a look at some of the sentiment indicators out there. By the way, these charts that I show, and pretty much every chart that I show on the Final Bar, are all part of a chart pack that you have access to as a StockCharts member for free. So if you go to your dashboard, go to all your chart lists, at the very bottom, there's a little gray button that says Manage Chart Packs. Click on that. It's called David Keller's Morning Coffee Routine. It includes these charts and a bunch of other ones that hopefully help you understand how we can use StockCharts to quantify these market dynamics. We'll start with the VIX. And as I mentioned, it's an interesting development that the VIX has come back below 30. If you look back through much of 2022 and really going back to the fourth quarter of last year, we have been in what I would call a particular volatility regime, right? And I think to I think of the VIX as not being a hard and fast thing. If the VIX is below 15 or above 25 or above 40, that particular level is universal. I think it goes in phases, and there are periods of elevated volatility. There are periods of lower volatility, and recognizing what regime we're in, I would say, is how I would describe it, is really important. And again, 2021, a stretch of fairly low volatility, ranging between 15 and 25 on the VIX. Here in 2022, we're ranging between 20 and 30, 35 on the upper end. If you look very simply at when the VIX went below 20 or when the VIX went above 30, for the most part, you pretty much have picked the turning points, the major turning points in the S&P. Low volatility has aligned with market tops. Higher volatility has aligned with market bottoms. Now, when we've had more of a sustained sell-off, you'll see that the VIX has gone above 30 and stayed there. Last time we saw that was in April and May. That was during this sort of down leg here, which again was pretty far before the eventual bottom in June. We had kind of a similar pattern there, late September to early October, where you saw the VIX sort of get above 30 and remain sort of in that range for quite some time. In the last week or two, though, the VIX has gone from around 33, 34 down to around 26, 27. And this is all of a sudden starting to see a lightening in volatility. Volatility coming down usually has an inverse relationship to stocks. So that's why I guess that lines up with the rally that we saw out of the low in early October. So to be honest with you, I think these things tend to move coincidentally, meaning I don't think there's a big leading, I don't think you can get a big jump on the S&P by watching the VIX, but I would tell you that looking at where it's at relative to these extremes can be pretty helpful. And what it also tells me is if we do get more of a sustained rally, which again, as we go into the next week or two, we're getting into the seasonally strongest part of the year, which is a time when it would be completely reasonable, if not expected, that the market sees some strength. Even if the big picture is more negative, we could see a bounce, similar to what we saw in July and August, right? We just continue to see some improvement. If that would happen, I think this chart could be incredibly valuable because I will be watching like a hawk for when the VIX hits 20. And at that point, you would hear me start to give warning signs that volatility is now very low. That means that the uptrend is most likely played out. It's upside potential, and I would start to be looking for signs of an imminent downside reversal. There's no guarantee we get all the way back to 20, by the way. Notice what happened as we went into the June low. We never got that too much below 25. So again, an important chart to watch, thinking about volatility now versus previously in 2022. Here we are looking at the AAII survey. This is a weekly survey of individual investors. Are you bullish, bearish, or neutral for stocks for the next 6 months? We can see as of this week's reading an increase in bullishness up to 26, 27%. And a decrease in bearishness down to 46%. It's still bears outnumbering bulls by about a 2-to-1 ratio, which is similar to what we've seen last 2 months or so, to be honest. But notice that the spread between bears and bulls is narrowing. So now there's only 19% between those two. At its peak, at the highest levels, it was around 40, 45%. We saw that in mid-September, and we saw that in late April as well. So what this tells me is people are getting less bearish and a little more bullish than they were at the going into the October low, but not to the point where there's any sort of real optimism yet on these charts. It still tells you the average investor is sort of underweight and in a state probably of disbelief, I guess, of this rally that we're seeing now. The simple way I would interpret that is still bear market rally phase. The name exposure index continued to go higher, and that's been the case the last 2 weeks, currently around 54%. And that's a survey of active money managers asking for their exposure to the equity market. So it literally is an average 54% net exposure to equities. Now, if you look at the data series going back over time, over many years, the average is around 70% or so. So still at 54%, that's underweight. So it's not telling you money managers are all in and buying in on the weakness. It does tell you that the level has gone from 15% about 4 weeks ago, up to 54%. So that's quite a swing in a short amount of time. That shows you that certainly you're seeing some money being put back to work in stocks. And again, the best evidence of that is the fact that the price has gone higher. Also note at the bottom, these are the RIDEX flows. This looks at the RIDEX family of mutual funds and sees what area of the funds that investors are in. This is mostly individual investors, I would argue, that use that fund family. And it's basically, are they rotating to the more offensive side or defensive side. When these red bars are really high, that means the value is very far from zero. It means the value is very high, which tells you investors are more on the defensive side of the tape. So if you look in October at the low for the S&P so far year to date, we were at the lowest level, similar to the lowest level for the year, and is very similar to what we were in March of 2020 and also December of 2018. Pretty encouraging if you're really optimistic about stocks and you think that you're looking for some sign that that could have been a bottom. There's your piece of evidence. Here's the problem, though. Look back to 2016, look back to 2008, 2009, and you'll notice that at those times, the RIDEX flows went way more defensive. So even though investors are defensively positioned, they're still defensively positioned like they were during major pullbacks in a secular bull market phase. If this is more of a protracted recessionary bear market, arguably this indicator certainly has room to go much, much further to the downside, meaning the values are getting higher and higher. Important chart potentially to watch there. And again, still telling me overall defensive and not certainly as bulled up as we could be if we see market going higher. Finally, put-call ratios, and I would just point out the fact that put-call ratios were fairly high there going into late September. In early October, which was the actual bottom, the put-call ratios were not nearly as high as they were in late September, which is actually an interesting data point. So the S&P made a new low, excuse me, while the put-call ratios did not make a new high. These tend to be inversely related, meaning put-call ratio tends to be high at market lows, tends to be low at market peaks. So as the market would continue higher, if that's what happens, look to see if the put-call ratio comes down and retests some of these levels that we saw back here in April at the peak, maybe here in June and July into August. We still have room to get to those levels of previous market peaks. We need to wrap this show, folks, and boy, 30 minutes goes by so quickly, but it's a pleasure to bring these updates to you. Let's go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P daily chart. We're keeping it super simple on the 3 and 3 today. And I just wanted to point out this candle pattern. Maybe this is a better one to show this, this candle focus. You know, I like to highlight candle patterns because they're a great short-term indication. We highlighted this one in the second week in October because it was a bullish engulfing pattern. You saw a bunch of those. And what that tells you is that the sentiment, at least in the short term, has changed from fairly negative to way more constructive. And that ended up being so far the bottom for 2022. You see a negative bearish candle here right as the S&P is testing its 50-day moving average. To me, that tells me to expect some weakness going in through the remainder of this week and into the beginning of next week. I'd see if we can eclipse the highs of that candle. We get above that candle, get above the 50-day. That's when you can clear the way to 4,000, 4,100, some of those maybe more aggressive upside targets. But first things first, we have to get above that short-term bearish candle that we had yesterday. Chart number 2, the Qs. And I was mentioning to my premium members earlier today, the market is fine or the market is struggling, and it depends on how you define the market, right? If we define the market as the NASDAQ 100, I would argue conditions are actually still fairly weak, right? The Qs made a new low in October, and even though they've rallied, they've not touched their 50-day moving average, and have even failed to make a new high for October, just barely, maybe by a rounding error, did there earlier this week, but really not a dramatic uptrend just yet. I would want to see the Qs put in a higher low. I would love to see the momentum improve and have the RSI get above 60. Those are the characteristics of a market in more of an uptrend or more of a recovery phase. At this point, we're seeing the NASDAQ 100 coming off of a new low, not making a new high, and below 2 downward sloping moving averages, which by definition is still a downtrend. Having said that, boy, let's finish off the show on a positive note. There are plenty of stocks making new highs, and then there are plenty of stocks in uptrends. And it's not just one sector. It's not just one particular group. It's a lot of them. Look at consumer discretionary, look at consumer staples, look at energy, look at financials, look at healthcare, look at industrials, and any other sector in between. You probably can find some stocks in decent trends. GPC is a great example of a chart that has completely bucked the trend in 2022, recently coming off of a resistance level around 165, making a swing low and then rallying above that 165 level. Those are charts that are constructive despite what you may think about the broader market environment. It is always a good time to own good charts. Folks, that is a wrap for the show. Thanks so much for joining us every weekday after the close for the Final Bar. Special thank you to Jesse Felder joining us from Sedona, Arizona with an update and good long-term charts on the S&P. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.